Hi, everyone. I'm Scarlet Fu with Bloomberg Television. Thank you for joining us for this panel. We know the best investments often are made in times of stress and uncertainty. The current crisis obviously is changing the way we live, changing how and whether companies can survive, and certainly how they go public as well, how they raise money. Therefore, getting a view of the big picture is absolutely critical. So our focus this next hour will be how to manage disruption over the next decade. We're going to focus on the trends and the opportunities that'll shape our future. And our panelists include Beth Ferreira. She is general partner at FirstMark Capital, which is an early stage VC firm. Beth invests in a broad range of consumer companies. We also have Gregg Lemkau, who is co-head of Goldman Sachs Investment Banking, but he's done just about everything at the firm, including serve as co-head of global M&A, tech, media, and telecom, and healthcare for the investment bank. Also, two private equity titans. Chris Stadler is managing partner at CVC Capital Partners. He oversees private equity activities in North America. And Brian Sheth is co-founder and president of Vista Equity Partners. Now, there are some disruptive headlines on the firm, but we won't go there because it has nothing to do with our panel discussion today. What I will say about Brian is that he focuses exclusively on investing in software companies. Great to have everyone here, and I'm so glad to be able to start this conversation with you. I think where we want to start is I want to get a sense of your thought process as we look at the path ahead here, because you never know what the future will bring, but generally there's a framework that people use. How do you think about managing disruption 10 years out when there's no visibility on November or 2021? And Gregg, let me start with you because you're a banker to companies and governments around the world. What do you see right now?
Yeah, thank you, Scarlett. It's great to be here and great to be here with my fellow panelists. I find it's actually sometimes easier to plan 10 years out than it might be 10 days out or 10 weeks out because you're so focused on the here and now. But over a longer period of time, you can take a broader perspective. I look back at my career at Goldman Sachs. I started 28 years ago, before there was cell phones and email, and you actually had to go look at the hard copies of annual reports to get financials on companies. And so much has changed since then, but you would have never predicted it along the way. But I think what you want to do is you try to play the trends. I think there will be continued technological innovation. I think the technological innovation we'll see going forward will be around artificial intelligence. It'll be around bots. And I think our objective is to try to get things to commoditize even faster, to use technology as best we can and try to focus on what differentiates us with our clients, value-added advice and value-added judgments, and really focus the efforts there. And use technology and any advent technologically to try to drive change going forward. And I think over a 1 year or 2 year period, it's hard to do that. Over 5 or 10 years, you can kind of look forward and try to see where you want to get to. I'd say the other piece I'd observe is, I don't think we've been through a period of more disruption in any of our careers than we have been in the past 6 months. And so, that experience of instead of hypothetically saying, God, what should I do differently? When you're forced to do things differently, that's when you change the most. And we've taken 89 companies public since March, all virtual roadshows. So you can't go see investors. You can't fly around the country like you used to. We've sold 100 companies, all with virtual management presentations. So I actually find that sometimes during a crisis and during a major period of disruption is when you're best able to think about things like change, because you're forced to not just do things the way you've always done them, but have to do things differently. And I think those are the kind of things we'll do differently going forward.
And those presentations hinge more than ever on the people who are really showing and sharing how they're thinking about things. Chris, as someone who invests in private equity, how are you thinking about the management teams and the resiliency that they show?
Well, actually, that is the key word for us, Scarlett, that we've seen demonstrated. The importance of that demonstrated over the past 6 months, to Gregg's point, is resiliency. And watching people have to deal with something that they have never seen and probably never planned for, never thought about, and what they're able to do. We've been pleased by the reaction broadly of our management teams to figuring out how to protect value, how to protect employees, customers, and then also how to turn it to their advantage and see ways to bring forward some changes that we were anticipating on doing anyway, and to Gregg's point, move much quicker. And so I think that's been one of the few bright spots of a period that we've been through, is to see the reaction of our management teams that way.
Beth, I mentioned how you invest in a broad range of consumer companies. How will the consumers' wants versus needs change over the next decade?
Yeah, I mean, I think that is a really big question, and we're still seeing that evolution of what the consumer is going to want and need and how they're going to spend over the next two to 3 years. We haven't seen a huge difference in consumer spend in the last 6 months, but there's so many different factors that haven't come into play that we do think that come this holiday and beyond, we'll start to see those changes. The nice thing about what we do and the earliest stages that we're thinking about those changes. We're investing 10 years out. Most of the companies are starting to think about what the earliest glimmers of hope or what our changes in the market are going to be. And so we're seeing a lot of new innovation coming out of this, and we expect that there'll be continued new businesses, whether it's how we consume media or how we shop, how we interact with different people in our social circles. We're going to see a lot of different businesses come out of this.
And of course, that interaction always involves software and technology. Brian, as exclusive software investors, what does this mean for how you project out your investments?
Yeah, thanks, Scarlett. Thanks for having me here. And hey, everyone. I think that all the panelists have made great perspective comments on what we're dealing with right now. What Chris said about management talent and battling through this time of adversity and being resilient is absolutely critical. And software, you kind of always plan for disruption. That's to a certain extent our job. We're not doing our job for our customers if we're not always coming up with something new and different and innovative, as Beth said. And for Vista companies, which by and large are a little bit larger, maybe a little bit more mature than traditional software companies, and we think about what this new and incredible level of disruption is going to do for the next trajectory of growth. What's been kind of fun for us is that, these are one of these few opportunities where many of our customers are really thinking about how to take advantage of what's going on and make some major investments in perhaps advancing some of their digital plans. So for one of the examples I'd give you is some of the talk around artificial intelligence and machine learning, for example, what Gregg was discussing, are really getting put into action. And it takes a tremendous amount of time and investment, for example, to invest in things like robotic process automation, investment in automating certain aspects of maybe the more commodity-like services that people are doing right now in certain companies and industries. And companies, after they're back on their toes and not on their heels like they were in March and April, are really thinking, and in some cases now making those investments. And they're really thinking about, what does my digital business want to look like over the next 10 years? Because they can't wait anymore. They can't pause on their investment in software.
Chris, I wonder if you can share with us the best investment you made in the last crisis that paid off in a really big way, and how your playbook is similar or different this time around.
Well, that's a great question. I think one of the interesting things about times like this, they're often characterized by great indicative value, but nobody willing to trade. And so, we made very few investments in 2009, despite making a tremendous number of offers. Personally, the best investment we made was the only LBO that closed in fourth quarter of 2008 for Pilot Travel Centers, which does fuel for truckers and everything else they need as well. And that suffered greatly in terms of volumes during the crisis, but it was a leading player that was actually able to take advantage of that disruption in terms of the arbitrage that they were able to get on fuel prices, and then also just take share. And so what they did was, one of their competitors went bankrupt, one of their largest competitors, and we signed a deal to acquire them in 2009 when financing was still very, very difficult. And that was really the key to success of that deal. This time around, we're finding that a lot more difficult. And we talked the other day when we were getting ready for this panel about the fact that everyone kind of knows that playbook. It's like right after the recession or in the middle of the recession, there's great buys available. Well, the Fed made the cost of money zero. Everyone remembers from last time. And so it's been very difficult to find anything trading cheaper. As a matter of fact, what you've seen is just, these barbells of real distress, like companies that are completely out of business and do they need some rescue capital, and then companies that have kind of sailed right through those are getting premium multiples. And to the extent anybody wants to show a mark or get liquidity on an investment like that, it's bid up to prices that and multiples that were higher than just last year.
Beth, what about your playbook for this time around?
Yeah, I mean, we're seeing the same thing. We initially came into this period thinking this is a great time to put some capital to work. After the 3 or 4 weeks that we were buckled down and making sure that our existing portfolio had the capital it needed and were in good places, it was like we looked around and all of those companies that we thought could be great investments were either getting the capital from their existing investors or just not going out at all, waiting to get that capital, or in the other case, getting bid up. So I think that the playbook is well known, and not only is there a lot of capital out there, but they're realizing that it is a good time to invest and to lean into your existing companies.
All right, so let's get to the elephant in the room, Gregg, and talk about the amount of capital that's out there, because one thing that you had mentioned to me that's underappreciated is just how much money has been raised. And it's, of course, backed by the Federal Reserve, by central bank support. What are the ripple effects of sound companies, financially sound companies that are more cash rich than ever? What will deployment of those funds look like 5, 10 years down the road?
It's a good point, Scarlett. And as I noted, I think the story of the pandemic from a market perspective has been the resilience of the capital markets. And it's been the resilience really supported by swift action from central banks and from the Fed. So the system's been flooded with money. And what it allowed is for the companies that needed to raise capital, in particular in those early months of March and April and May. The companies under most stress, the airlines, the travel businesses, the cruise businesses, the restaurants, all raised capital. And first it was investment grade, and then it was non-investment grade. That actually gave some stability to the markets, and it had the equity markets rally. And the equity markets rallying has opened up the IPO markets and has driven confidence again around the M&A market. So the markets are functioning unbelievably well. But as you say, there's a significant amount of capital out there. As Chris noted, it is practically free. And the question is, what happens down the road? I think the good news in the meantime, in the near term, is we've got significant amounts of capital available for companies that need it to help keep the businesses afloat, hopefully keep employment and keep investing in business. I think that investment will continue, and we'll see continued innovation. We've seen accelerated growth in technology and biotechnology with the availability of capital that's been investing in accelerating change and innovation. And I think if capital can be deployed that way, it'll end up being a very positive for the markets and the overall economy.
So I want to pick up on that point about keeping companies afloat, because in looking at the fallout from all this excess liquidity, it's pretty hard to tell a good company from a bad company when easy money gives every company the veneer of solvency. When easy money impairs the fundamentals, how do you go about gauging best-in-class companies, identifying the right opportunities? And Brian, since you're in software, since you're looking at tech, I'll ask you that question first.
Yeah, there's a lot of ways to evaluate whether companies are running effectively and efficiently in software and technology. A lot of investors really focus on growth, and for many investors, that's the only thing that they like to focus on. Some of the metrics that are probably good to look at are, how much are people spending on customer acquisition? What's the return, the long-term return you're going to get acquiring each of these customers? When capital is free, as Gregg and as Chris have alluded to earlier in the conversation, it could turn into a free puppy over time, and that, they overspend on acquiring the wrong customers, and then that ultimately hurts a company down the road. So I think when you're evaluating these types of businesses and you're saying, okay, they have access to a lot of capital, how are they using it? And are their efficiency metrics around utilization changing? If they're not, how else are they using capital? Every great business should have a great management team, and those management teams should always be thoughtful around when capital is available. How can I spend it? Can I invest more and build better products faster? Or can I go buy out some of my competitors or some interesting companies in our ecosystem so that we can provide our customers more in the long term? So that's how we really kind of evaluate whether or not, there are great companies with great management teams. But you can mask a lot of that if you're not paying attention, or I should say, you can mask a lot of it if other people aren't paying attention to the underlying factors that contribute to your growth.
Do you see that in your part of the market, Beth?
Yeah, and I think, one of the things that were alluded to earlier was that you're starting to see people paying for growth. and paying for great management teams. And I think this is the reason why. And you start to see companies with great unit economics, with a sales cycle that really works and is throwing off cash. Investors want to back those companies, and that's when you see these multiples get a little bit higher than you think they should be.
So does it matter at all if we're in a bubble with all this government intervention? I mean, there are a lot of questions being posed. Certainly when Jay Powell holds his news conferences, people are asking whether equity prices are in a bubble. If we're not in a bubble right now and we do get to one, does that matter at all, given all the intervention and given the fact that there will be continued support for years to come? Chris, what do you think?
This is one of the toughest questions. I remember early on in my career, I saw somebody definitively call a bubble who was the leader in one of the leaders in the private equity industry at that time. It was Teddy Forsman, and he talked about what people were doing with wampum and high yield, and it was 1996, and he said, I'm completely out. And 2 years later, it had just gotten better, and he couldn't go back in and buy the exact same companies you talked about being too expensive at 7 times back then, 9 times 2 years later. So he plowed all his money into McLeod and NextLink and lost his franchise. And the lesson for me was about trying to call a cycle when your investors are invariably invested across asset classes and need to put money to work is really not the job I think they're asking us to do. The job they're asking us to do is to put money out consistently across good companies, to your point. And so, a bubble will define whether or not you're holding something longer. It'll influence your IRR. But if you make a good call on the underlying company and the underlying management team, you're still going to be okay. And I think that's what we're trying to do. We're also trying to make sure that in a time like this, when it is expensive, you make sure you're taking advantage of that with your companies that are in a better position to exit as well.
So this idea that Beth referred to about paying a premium for growth, why is the current disruption so bearish for any kind of value play? What kind of patience do investors have over the short term, over the medium term, for a value plays to come to fruition when money is so cheap and when there's no shortage of demand for any kind of growth? And Beth, I'll throw that question to you.
Yeah, so I don't know if there is a bearish on the value play. I think there are a lot of investors that are sort of fishing for that, value proposition and don't want to be in a bidding cycle with other, investors. So I think they still will get funded, and I think that could be a great strategy. But I think the question is how long those investors will be holding that asset and how long it will take to get to the other side of that investment.
Yeah, Scarlett, I'd just add on the value versus growth, because it's a hot topic everywhere. And I think that in a low interest rate to no interest rate environment, there's just a premium on growth. You can hopefully grow your way through it. I don't think people are sitting around and saying, oh my gosh, my fundamental model tells me this is worth 20 times revenues. But they're looking at rapid accelerating growth and finding when these companies can grow into the valuations that they might expect. I think the value investors are frustrated right now. I was actually with a value investor the other day who was almost bemoaning the existence of his industrial portfolio and saying he's starting to think that the only reason these companies exist is actually to buy software from high growth tech companies, which I don't think is their actual reason, but I can see why an investor might think that some days.
Talk about worlds colliding there.
Well, it's kind of interesting. It does bring an interesting point, though, Scarlett, because I think, look, Brian and Vista decided to build their firm at a time when it was an unbelievable time to get into software, been overweight software, and done a fantastic job. We've seen a lot of their companies. We didn't do that, unfortunately, but we haven't suffered in terms of our own returns. And one of the ways is to actually have those companies embrace the use of technology and to force them to modernize their own business. So some of our best successes are really taking businesses that are not technology companies per se, but forcing the aggressive introduction of technology into their business. We've got a convenience store retailer in Poland that is by far the most sophisticated company I've seen in terms of what they put on their shelves. And it's through artificial intelligence and a lot of data mining that tells them with a very small store, right, I got to get it right. And then they're constantly adjusting their mix, and just an unbelievable company. And I'm a gaming business called Tipico in Germany that when we bought it, it was mostly retail. We pushed it aggressively to focus on its online model, and then we get into a situation where there is no retail model, and so we've had a lot of success in doing that. And so those companies are still going to exist, and they're really going to exist and flourish if they do learn how to take advantage of the parts of their business that are still less technology focused, still person to person, but they're going to be a leader in their sector in the use of technology.
Well, when we talk about value or things that are ignored, whether it's industrial companies, another area of the economy, of the market that's ignored and is not seeing a lot of bids is commercial real estate, and commercial real estate in big cities. Brian, you were talking earlier in our our preparation call, that you hope nobody here invests in commercial real estate. What are your observations on how things stand from software companies? Because there's a lot of hope that once we get a vaccine, things will recover, but I wonder if something's permanently changed for commercial real estate.
You're not making me a lot of friends outside of software today, Scarlett. I think that, I can only go from our own portfolio. So we have 75,000 employees, and as we've been talking to them over the last several months, it's very, very clear that big chunks of them are really comfortable in this, remote workplace model. With some exceptions, I think our employees with young families are ready to go back to the office. And I think some of our older employees are ready to go back to the office. But I think everybody else really wants to spend less time commuting, spend more time with quality of work. Gregg had mentioned in our prior call, people aren't going to get on the plane and fly for one day for a meeting anymore. And I think some of these changes are going to be more permanent. Specific to real estate, I think what you're going to find, especially in software and technology, is some of these areas in the country that have historically been the hotbeds for talent, for technology, places like here in Austin, Texas, perhaps, and Silicon Valley and the Route 128 corridor in Boston, they might be less important going forward because larger companies are going to be more open to looking for talent outside of where their headquarters are, recognizing that employees can be productive, and at least a lot of tech companies and other white-collar jobs from wherever they sit. The implications for commercial real estate, I think, at a minimum, it's going to have to change. Headquarters, offices are going to have to change. What people want now is collaborative areas. They want the opportunity that when they are in the office, spend time with one another, working on creative things. They want inspiring. I don't think people are going to go back to queues if they don't have to very soon, regardless of how quickly we get monoclonal antibody therapeutics or vaccines or whatever it is that's going to get us back to pseudo-normal.
I want to go back to the bubble point a little bit earlier on, because we have an audience question here, and I'll put it to Gregg. Given the amount of liquidity in the financial system, which market has the biggest bubble, if any, in your opinion?
All right, Scarlett, you tried to get Chris to bite on the bubble question. Now you're trying to get me.
This is the audience, not me.
Exactly, I know. Listen, it's hard. It is hard to call. I think as you look at the different markets today, I won't call one a bubble or not. It's relative value, and I think people are looking at relative value. And I think the reason the equity markets have traded up so highly, and in particular the growth stocks have traded up so highly, is it's relative to what you can put your money in the bank and earn nothing. In some countries, you can lose money by putting it in the bank. And as I think you're looking at relative value, that is what compared to historical times is making these multiples look quite high. But it doesn't feel like there's a bubble in the market necessarily. I think the thing that is happening around some of these elevated valuations is probably a bit of an assumption of perfection in execution. And so, we've all seen the models. You can look at the models of how these companies grow, and if they get to a certain level of earnings and profitability in 2026, and you discount that back, it actually is a very good value today. The question is, can it credibly get to those levels? And I think people are putting less discount around execution and assuming more certainty in execution, and that's why they're convincing themselves they're able to pay the valuations that we're seeing in the markets today.
Okay. Well, I'm going to throw another bubble question in there, but it gets us to our next topic, which is those special purpose acquisition companies. They're obviously the new shiny thing right now for 2020. Chris, do you think we're in the middle of a SPAC bubble? And if so, or even if we're not, what does it look like on the other side when things kind of come back to normal? Will it inevitably involve a wave of private buyouts to untie exposure for investors?
That's an interesting question, and we've seen a lot of activity with these approaching our portfolio companies. And I think Gregg said it best the other day when we were talking, which is that I think, in my view, that SPACs came along because the process of taking companies public has been fundamentally broken for 20 years. And so this was a way to try and do that in a more efficient fashion and address some of the issues with taking a company public. It's created its own issues in terms of whether or not that's a great way of doing things. But I'm just hopeful that through that disruption, that we get to a place where there is a better way of bringing a company public, a better way of having an idea of where your value will be when you actually trade public. I think they will stay. They'll be around. Already, you've seen a lot of innovation and some separation between people who are viewed as really adding value as sponsors and those who don't.
Beth, I know you're early stage VC, but do you see more companies wanting to go public in this kind of environment, or are they looking for other exit strategies?
Well, I think it depends on the company. We have a company in our portfolio, DraftKings, that went public about 6 months ago via SPAC. And that SPAC was a great option for them. It worked really well for where they were in their business and some of the regulatory challenges that they had. And it's traded up and it's done incredibly well. We have a lot of companies in our portfolio that are being approached by SPACs. And, I don't think it's right for all of our companies, but it may be right for some of them.
So, Gregg, how do you think about the split between SPACs, traditional IPOs, or even direct listings, which we thought were going to really take off, but actually haven't as much as you might have thought?
Yeah, and Chris touched on it. My hope and expectation is we'll see the path to taking companies public continue to evolve and taking some of the best elements of the traditional IPO, of the direct listing, and of the SPAC. And each of them have great strengths and each of them have weaknesses. I think the direct listing is interesting for some companies, but so far you've not been able to raise capital alongside it. And a lot of companies need to raise capital when they go public. The SPAC works for a number of companies, and the traditional IPO works for a number of companies. What's been fascinating this year, we are on pace to have a record year for IPOs in 2020, which is kind of amazing in the midst of a pandemic. We've had 138 SPACs go public in 2020, raising $52 billion. That's been half of the volume in IPOs in the US. So it is a real alternative. The structures have evolved to make it credible. I think they will continue. The market feels like it's starting to choke on it a little bit from a supply-demand standpoint. And so it almost is saying, sit tight for now and let us digest what we have. I think ultimately, as in everything, there'll be a performance differentiator. And those sponsors of SPACs that do well and perform well and add value will be able to continue to raise money. And those that don't will be one-hit wonders and won't come back to the market again. And that'll be the shakeout we see. But actually, I'm hopeful that over time, the market evolves in a way that there are now three paths to take a company public, and the best of each of those three can work for each company.
Brian, how about you? What do you see in the meantime? SPACs versus IPOs?
I think one of the things, I think everything Gregg said was spot on. And one of the things about the SPAC is they probably offer an alternative for companies that are growing quite as quickly. And I think part of the reason why some of these SPACs are so successful is because they're sponsored by serial qualified investors and entrepreneurs who the investors in the SPACs recognize have great judgment around what a great company looks like. It's one thing when you've never heard of someone who's raising a SPAC or doing something like that. It's a whole other thing when it's someone like Ben Chu or Bill Foley or somebody who has been successful for decades and has a great track record of being good steward of capital. And my guess is that they are not just looking for the 30-40% growers. They're looking for great, stable businesses that they're going to want to own for a long time. And because of the economics of the SPAC, there's an incentive for the sponsors of the SPAC to find those businesses that are going to be very resilient and really good investments for a long period of time, because that's how they make their money. So I think in the right SPACs, there's great alignment. And I think that's what's going to make them, continue to persist and endure. I think for some of the one-hit wonders, as Gregg said, people will see that they weren't bringing great investments to market, and they're not going to get re-upped for a next one.
What happens, though, reputationally to investors with an institutional client base that gets stuck with a bad asset? I mean, how long does that stay with them for? And Chris, I'll ask you that question.
Are you speaking in terms of the sponsors of a SPAC or selling into one? Yeah, I think for the
selling
sponsors,
into one in particular.
Yeah, look, I think for us, when we think about selling into it, we think exactly the same way we do about an IPO. And we care very much about whether or not the company we're bringing is one that is going to be straight with investors about their strategic plan and what they think they can do and ultimately deliver, because we think more and more that that is going to help our record of bringing companies public and be more successful. And so we evaluate it the same way. The difference is, does the sponsor add anything in terms of getting it over the line? Is it a Chin Chu or a Bill Foley? I think two great examples that I think do bring an awful lot of credibility to it. And the other element of it that I find interesting is you are able to do it through a merger document. So you're able to engage in a different selling process that allows for the management team to do more with the potential buyers, and they have an opportunity, particularly if you're doing a pipe as part of it, to get a better and more certain allocation in a deal, right? And so that's the problem that it's solving. And for us, it's all about getting to that point where we've got an investor base that we want, that has the capacity to buy a lot more, that's high quality names, and that, as we know, doesn't happen until you're out there for 3 to 6 months, sometimes longer. But I think the SPAC process can help you get to that sooner, particularly if you're doing the pipe.
Okay, let's move away from our SPAC detour here and go back to some of the long-term issues. And I know that when I talked with each of you during the prep call, we talked about some of the concerns you have as you look at the big picture. And Brian, you had mentioned burnout and mental health is a big concern. With everyone working 24/7, no one in their office buildings, but sitting at their kitchen table. What do you do to ensure that your staffers aren't running on empty, to make sure that mental health is a priority and stays a priority and doesn't get compromised here?
Yeah, it's a great question. And it's probably my biggest concern about our folks who are working so hard at Vista right now. The best way that I think about mitigating that is by making sure that we have the right people in place who are managing the experience of the mid-level and the junior folks who are working so hard. So at Vista, we spend a lot of time thinking about who are the best culture carriers, who are the ones that make the Vista experience great, not just from an investment standpoint, but from a work-life balance, a mental wellness standpoint. And that group of folks has really done an amazing job. And I was just on a call on Wednesday for 2 hours with them and a bunch of our newer associates and analysts, just talking about all the different things that they've been doing to make things fun. And it's incredible. I'm too old to be as creative as these guys, but it's incredible what they're able to do on Zoom, the fun games they play, the way that they communicate constantly, the things that they talk about, and how open they are with one another about the problems that they have. That is absolutely critical. I think maybe folks my generation are maybe a little bit less open about the things that might be affecting us from a wellness standpoint. And this next generation, they do a really great job of expressing themselves, and if they feel trust with the folks who are responsible for kind of their experience at Vista, they're very good about having that dialogue and that communication. So that's been really helpful for us. But look, I do worry about it. A lot of folks who are early in their career, these 6 months, which will probably end up being a year of kind of Zoom only work, is hugely impactful to them, and they don't have as good of a sense. As much trust as maybe the rest of us panelists do that things will change and get back to some version of normal, which will include in-person interaction and a little bit more in-person fun. And so I think it's incumbent upon us who've been around a little bit longer to tell them this too shall pass. We will get back there. And in the meantime, let's have some fun together and figure out some new and creative ways to interact with one another and get to know one another better.
Yeah, you touch on something critical, which is nobody really knows to what extent any of these changes that have taken place are actually permanent and what kind of snapback we'll get in terms of how people spend their time, spend their money, and do what they need to do. Beth, wellness and mental health, these were all very big even before the pandemic, but now, in the wake of the pandemic, it actually has created a lot of opportunities. And you talked about how there are opportunities in healthcare. What do you see going forward?
Yeah, I mean, so telemedicine and telehealth was on a growth trajectory before COVID, and now COVID has accelerated that. And so companies that have created a product that can help whether it's on the addiction side or it's women's health or mental health. We're just democratizing the access, making it much easier to get the therapy you need, the prescriptions you need over in this modality. And we're starting to see that acceleration. So companies, we see a lot of new companies being created, but also companies that actually have that product are accelerating really quickly. So particularly in areas like, I mentioned addiction. Addiction, there's not enough treatment centers in the US right now for those who have opiate or alcohol addiction or, across the board. And this will help open up the opportunities for people to get the help that they need.
And that extends to biotech as well, Gregg. I know that's an area that you were looking at as something that could really break out.
I think about probably one of the places we're most excited is biotech, and I think it is possibly underappreciated, notwithstanding the size deals we're seeing get done. But I think the innovation that we're seeing, actually true scientific innovation around gene therapy in the biotech landscape is accelerating and is at a greater pace than we've seen over the past 20 years, we've seen in the past 2 years. And I think that is only going to continue. And as I look forward for the trends that are most exciting, we've seen the software wave of the past 20 years. I think the next wave like that is going to be in the biotech world.
I mean, the common thread here, of course, is technology. And there's this deep, deep conviction that technology will add to our processes, will be a value add in every way to operations. But there are costs along the way. And there are instances in which technology doesn't always deliver. Where and how do you see technology perhaps missing the mark, failing to deliver? And Chris, I'll pose that question to you.
Well, I was on a Zoom call last night with the guy who made the Social Dilemma movie, and it was a really interesting call. It was, I think, a movie I watched that had the biggest impact on me in quite a while, and I think so socially, in terms of social cohesion, I think that's the place where technology has missed the mark the most, and I don't think there's that second place is even close. And there was a hope, and I think originally we did see more of it, where it was bringing you in touch with more people, and you were able to share with more people, and that would somehow reduce barriers, make us all seem more alike. And I think it's been taken over by forces that want to exploit our differences, and it's additionally made people just more socially introverted. Right. And I've noticed that. I noticed it first when I started interviewing people and realizing that they were actually just less. They seem less comfortable with the process of the interview than prior generations, because they're so absorbed in their technology. And you can see it when kids are in the same backseat of a car and not talking to each other. They're focused on their devices. And so I think that is the role for all of us going forward, is to try and turn that back around and get technology help us bring greater social cohesion, and teaching people how to limit it on the first basis, but also to use it to bring people closer together.
That's a great point. Technology digitization creates winners and losers, and we've seen that through time, but we've seen it also exacerbate all the existing inequalities out there. And of course, the acceleration of this process threatens to leave even more people, more communities, more constituencies behind. So as investors who invest in management teams, Beth, Chris, Brian, how do you ensure that the management teams are addressing this properly? And Beth, I'll start with you.
Yeah, it's something that is top of mind in most of our board meetings and conversations with our CEOs right now, is how do you democratize opportunity across your company? There are task force and groups, support groups and smaller groups, and I think what happened through this period of being at home or working remotely has caused companies to actually raise their game from a communication standpoint and an inclusion standpoint. So not only just from the standpoint of making sure that everyone is doing what they need to be doing and having the support that they need, but also making sure, as we're thinking about adding new people to the company, making sure that the funnel is as wide as possible to make sure that there is diversity at all levels of the company, and including the board, and making sure that the entire company or big parts of the company are part of those conversations.
Brian, what do you think? How are the management teams you invest in addressing the inequalities caused by increased digitization and technology adoption?
Yeah, it's a big topic at Vista, and we've made kind of Vista level investments, and I've been really impressed with how our management teams have responded and in some ways really gotten the conversation started. So at the Vista level, we've made investments in kind of diversity training and diversity and inclusion hires to make sure that they are helping our portfolio companies implement systems that'll at least make sure that our processes are better and are more open. We started this a long time ago when we recognized that if we left it up to companies that operate in certain geographies, they tended to get really not very diverse candidate pools. They tended to look a lot like the people who already existed and worked at the companies, and so we put a lot of testing methodology, a lot of personality processes, evaluation processes in place. And that really contributed to diversity of thought and diversity of look relative to the tech industry. But frankly, that's a really low bar. And so now I think we're being much more aggressive in making sure that we're implementing new systems that get us our results faster. And it's been amazing how quickly our management teams have responded, and then, like everything at Vista, given us even better advice. So our playbook at Vista is really just an accumulation of what's worked really well at our portfolio companies, and they're nice enough to share with the rest of us. And so we try to get back out to all the rest of the portfolio companies so they know what those best practices are. And it's really been leadership from a number of our different companies, Mindbody, Jamf, Tibco, Cvent, who have come up with these great programs and really look at metrics around diversity, look at metrics around gender, look at metrics around LGBTQ, and they have very open dialogue with their employees around, how are you feeling? What's the tenor inside the organization? Are people comfortable with how we look and act and feel and work together? And I think that openness and that communication and that transparency is critical.
Chris, what about you?
I think, look, our asset class has grown so much over 20 years. And I know a big point that the Milken Institute focuses on, and Mike in particular, is that we are much more important to the economy than we used to be. I think it's kind of low to mid 20s in terms of the percentage of the economy that is now owned by alternative investment managers. And that comes with a responsibility. And the way we're looking at it more broadly is just to say, when we need to leave these companies better than we found them. And it goes without saying that we got to do that for investors, but it's going to be a much broader report card, and it's going to be the employees, and it's going to be the customers. And if we're not, driving up the numbers of employees at our companies from when we started, driving up the amount of economic gain that they are sharing in, then it's going to be a tough conversation that we're going to be having. And frankly, it's not a place that I want to work if we're not doing that. And I think it is going to be something we're going to have to do. Unfortunately, our government is not proving itself up to the task, and I think it's going to be our responsibility.
And of course, this all folds into ESG, environmental, social, and governance overall. I wonder to what extent, because of the pandemic and our response to the pandemic, that we've kind of moved topics like sustainability and climate goals lower in the priority list. How much are they on pause? Where does it rank in terms of priority? Gregg, how do you see companies adjusting their spending, their investing on green initiatives, on tackling this?
So the ESG had been a massive theme really for the past couple of years, accelerating in almost every discussion we had with clients, with boards, with investors. And I think it's continuing to be important, but I'd say the thing that's been most notable in the past 6 months is the E of ESG had been the focus over the past couple of years, really focused on climate. I think the pandemic has caused that to shift a little bit towards S, towards the social part of it. And I think in the early days of the pandemic, when the economy stopped and people didn't know if they were going to have jobs, people didn't know if their businesses were going to make money, didn't know if their communities were going to survive, I had discussions with almost every CEO client on the social purpose of their company. What is their objective? Is it to maximize profits in that quarter or in that year? Is it to keep all their employees employed? Is it to invest in their communities? When we saw the Black Lives Matter movement and all the social unrest happen in this country in particular over the same time period, what was the company's goal and objective against that context? And I think it really pivoted in a meaningful way for most companies. I don't think that shareholder primacy has gone away, but I do think it's been mitigated somewhat in that companies and boards and CEOs in particular, and kind of authentic leaders in particular, focused on what is the social purpose of their company and folding that into their overall objective of making money. And so I don't think the climate goals have gone away, but I think the S in ESG has probably risen to the forefront more during this pandemic than the E had been prior to it.
Is this a permanent shift, you think, or a temporary response given what we saw in the spring?
Yeah, I would say I think the uplift in social good and social purpose of a company has been elevated and will stay that way, and stay that way in terms of consciousness. I don't think it'll put the E or the climate part behind. I think that is just too critical to the future of our planet and of mankind. But I think that one is going to need significant movement from governments as well as companies to make that work.
Okay, so as we kind of go ahead.
Oh, sorry. I was just going to say, I think that, the pandemic has really opened people's eyes to the importance of the E part of the ESG. I agree with everything Gregg said, but I would also add that, people recognize that the pandemic itself may very well have been caused by some environmental issues that we need to constantly kind of face. This kind of continuous destruction of wildlife and deeper into forests, eating and keeping animals where we shouldn't. People are thinking about these things in ways that they weren't beforehand. And I have a lot of family in India and in Bombay in particular, Mumbai, if you're not Indian. And they love what they can see right now outside their window. They don't love not being able to go out because of COVID, but they're blown away by how clear the skies are and the fact that when they're on their porches, they can breathe the air. And it's sparking conversations there about when things get back to normal, what should the level of industrial pollution be like? And should that be something that they all talk about? And that is being spoken about at the highest levels of business. And in India, that means it's also being talked about at the highest levels of government. So I think that people really are thinking about these things. It's not just, there's a lot of thoughtful people, especially in younger generations, who won't work for companies who don't make this a priority and don't make it something that they actually care about and act on. And I think that in this war for talent that we were in before, and we certainly will be in again as soon as things come back to normal a little bit more, everyone is going to have to be more thoughtful about it because their company's priorities and values are going to have to match what the company's base looks and acts like.
I completely agree,
Right,
Brian. And what we've seen a shift where that has become a CEO office issue as opposed to someone's responsibility in a department who looks at this. And I think the employee base and the customer base are making it so, as well as the investor base. And so to the point that Gregg made before, I think if you were behind on this and you're focused on something else right now, maybe it's distracting you a bit. But kind of like with the Paris agreements, all the companies said we're going to keep working toward those goals, regardless of what the United States does. And I think we're seeing continued momentum in these critical areas despite the pandemic.
Beth, you want to jump in?
Yeah, I mean, I think that the consumer or the end customer is going to demand it. They're just, I think the pandemic has put a fine point on what's important to people, and I think the whole ESG piece is incredibly important to consumers. So I think they're going to make their choice by where they put their dollars, where they go, and ultimately, it's instead of being a top down, it's going to be a bottom up decision.
And it goes back to that idea of what the Business Roundtable did to move the mission of a company beyond shareholder returns to addressing and including all the stakeholders. I wonder, as we start to wrap up our conversation here, I want to ask each of you what the number one question or the most frequent question that you get from clients is about managing through the disruption, whether it's through this year or through the next 5 years or for the longer term through the next 10 years. And Gregg, I'll start with you.
So the biggest question that comes up with clients in the near term is, when are you going back to the office? How are you going back to the office? How are you ensuring the safety of your people in doing so? And how are you maintaining culture in this period when everyone is remote? And then the broader medium to longer term question is the one you touched on earlier, and others have spoken on, is what does the future of work look like? And does it look like what it looked like before? Will it snap back or not? And it's been fascinating for us. We're in a service business. We've had two record quarters in a row in terms of productivity and performance when everybody's been working from home, and it's unfathomable. And I think there's lots of challenges about working on Wall Street. One had always been work-life balance. I think people are actually working harder and yet getting better work-life balance. They're turning their 2-hour commutes, they're taking an hour of that and working with it, and they're taking an hour of it and probably working out and feeling better, and they're actually home at dinner time. And so it's been fascinating to see the experience of a lot of people through this crisis. I think the biggest anxiety is, are you burning off the capital of long built cultures, and how do you sustain that over time? And in particular, how do you, in our business, which is an apprenticeship culture, how do you train that next generation? And I think our instinct is we need to get people back together so they can be creative and they can collaborate. I think that's right. But I'd also say, when I was going through school, we used to get together in person and do study groups. And my kids don't do that. They do it via FaceTime. And so maybe they can learn remotely. Maybe they can do it by Zoom. Maybe they don't need to be sitting there looking over someone's shoulder to do it. But I think that's the biggest challenge people are focused on, is how do you train your next generation, and how do you build and sustain culture when everyone's working remotely?
Yeah, it's going to involve a lot of trial and error. Beth, what about you? What's the number one question your clients end up asking you about how you're managing through all of this?
Most of our companies are hiring quickly. And so how do you hire when you're not meeting someone in person? All of the normal conventions that we had of having lunch with someone or interviewing them in person, and all of those visual cues. And then once you're starting to get those people, how do you onboard them? How do you retain them? How do you integrate them into your existing workforce? And then what does it look like on the other side when you actually come back into the office? So I think that whole life cycle of getting those new employees hired, onboarded, and then ramped up is the biggest question.
Chris?
I think initially it started with what we're doing with our portfolio companies. What are we doing to keep our people safe? And then the discussion shifted to how can you evaluate new investments? What are you assuming for the environment for the next 18 months? And how do you perform due diligence? Do you feel, how much of it can you get done virtually, and how much needs to be done in person? And we found we can do an awful lot virtually, and we've then been able to, in the new deals that we've gotten this far with, create the conditions for a safe in-person meeting, whether it's outside or properly socially distanced. And I think that will stick in terms of like a lot of these things we talked about. I think there will be more people working remotely from home. I think there will be less business travel for that really difficult trip to just for a 2-hour lunch. And I think there'll be more diligence that is done. More of the diligence process will be done remotely than it was before.
Brian?
All the things that the panelists said are spot on. The additional thing that I think we're getting questions on is, this going to accelerate or decelerate the pace of innovation? And March, April, and May were tough months for selling software and for our customers. And we saw, retention rates go up dramatically with our existing customers, and we saw new logo sales go down. We said, wow, maybe this is going to mean some sort of pause in kind of the pace of innovation and level of investment that customers are willing to make. And then June, it kind of took off. And looking at the numbers for Q3 right before this, 80% of our companies met or beat their pre-COVID plan for sales. So I think this is actually going to accelerate it. As we said at the beginning, I think that people have decided and companies have decided that now is too late of a time to have made the investment, made the commitment to digitize their business, and they're going to go all in on what people like to call the fourth industrial revolution. This is going to be a digital economy, and people can't sit on the sidelines anymore. One
thing that none of you mentioned, and what the media, what I end up talking about all the time is anything to do with politics, who the next president of the United States will be, whether there's going to be another round of fiscal stimulus. I mean, all the stuff that we spent hours talking about. Does this not matter at all? Because we're going to get an answer one way or another, and people will just adjust, companies will just adapt, and we'll kind of move on because these are kind of bumps along the way. Greg?
Yeah, so I think you asked and answered, I would say. I think it matters, but I think companies will adapt, and no one's going to predict which one is better or worse. Our research analysts put out a report earlier this week called the Blue Wave, talking about what happened if there was a Biden victory, and everyone reacted and said, oh my gosh, is Goldman Sachs saying Biden's good for the economy? It wasn't. It was saying if Biden won and there was a blue wave, there's more likely to be more economic stimulus. And in the near term, there's more likely to be actual greater economic growth as a result of that. I think similarly, there'll be benefits if there was a Trump re-election and a red wave. But it's so unpredictable, notwithstanding what the polls say. We were here 4 years ago and the polls said Hillary had a 91% chance of winning. So I think everyone's going to stay out of the predicting game and instead being in the adapting game and figure out whatever happens. I think companies are going to be nimble enough to try to adjust and adapt. I do think the one piece of politics that is relevant, to the extent people think that there will be a Democratic sweep and therefore likely changes in the tax code, I think we'll see an acceleration of private company and potentially sponsor M&A in the fourth quarter as companies are looking to lock in gains ahead of any potential increase in taxes. And that just plays right into the hands of this whole SPAC wave because those companies can close transactions quite quickly.
So that will be more of an offensive move or a defensive move?
Depends how you look at it. I think people will be looking to lock in gains when valuations are high and pay taxes at the current rates.
Okay, got it. Sorry, let's adapt then and move away from politics. I wanted to check in with each of you to share one example of how you are experimenting with your job, with your investments, with how you approach your investments, with how you approach going through managing everything that you need to, that you might have started off as a temporary measure, but may actually become a permanent fixture of how you do things. Brian, let me start with you.
Well, I can tell you at Vista that the work from home dynamic is going to be, a mix of work from home and in the office is going to be a permanent one. We've heard loud and clear from our employees that, they don't love it all the time. They miss one another, but they really appreciate it some of the time. And so we're going to see that, and we're going to see that in our portfolio companies going forward. And, some of our companies, not all of them, but some of them congregate around some of these high cost of living centers in the U.S. And what we've seen is a lot of our employees move during this pandemic to lower cost areas, to areas that are more, more beautiful, more work-life balance. They're moving to the mountains, they're moving to the oceans. And I think we're going to continue to see that distributed workforce. That's probably going to be the biggest and most permanent change, not only to Vista, but to our ecosystem and software.
Are you moving out of Austin? Are you moving to the beach?
No, I anticipated this 11 years ago, and so I moved from San Francisco to Austin, and I'm going to die a Texan. Hopefully not soon, but I love it here.
All right, so that is a permanent feature then. Beth, what about you?
So we as a firm did over 100 events a year, and which was really important for our portfolio companies and the ecosystem to connect. And obviously, those are not happening now. What we've moved towards is a much more specific industry, what we call guilds, to connect, finance leaders, people leaders through all of these different challenges. And I think that the attendance becomes much easier for people because they can just, log in versus actually physically going. And the conversations end up being much more robust and much more targeted. So I think we may actually move some of those events from person to permanently in the virtual world.
Greg?
Yeah,
experiment that could become permanent feature?
Yeah, I would say the way we take companies public and the way we sell companies should change dramatically. I mean, it's sort of goofy with the benefit of hindsight that you would take a management team on a plane and you go from Boston to Baltimore to New York to Kansas City to Minneapolis to try to raise money when you could actually just get on a Zoom and see them all in one spot. I think that will change forever. I think the investor roadshow will change. And then I think selling companies, Chris kind of touched on it from a due diligence standpoint. But if you think about, you want 10 potential buyers to come through and meet with the company, so you have to schedule 10 sets of schedules over a period of time. You've got to do 10 different management presentations. I mean, it's crazy. We now record the management presentation on video. They can watch it. Each potential buyer gets a one-on-one Zoom Q&A. They can do the virtual data room. You can do it all in a couple of days as opposed to over multiple weeks. You actually protect confidentiality because you don't have potential buyers traipsing through the corporate headquarters. And it's much less taxing on management teams. It's crazy to think we used to do things the way we did things. And so things like that, I think the necessary changes will become permanent.
And Chris?
Yeah, I think I would say in terms of the most impactful, it's what Brian said on the employee base and the much more flexible arrangements is between working in the office and working at home. And then I think as Beth touched on, I think we'll see a lot less physical travel, right? I mean, that's, I think, the other part that is expensive, a lot of low productivity time in there, and also pretty draining on people if they're doing it a lot. And so I think those two things will be permanent changes, a reduction in that.
All right, good stuff. Thank you so much, everyone. Thank you for taking some of your time to talk with us about the disruption that we're seeing and how you're managing through this. Beth Ferreira, General Partner at FirstMark Capital. We've got Brian Sheth, Co-founder and President of Vista Equity Partners. Chris Stadler, Managing Partner at CVC Capital Partners. And of course, Gregg Lemkau, Co-Head of Goldman Sachs Investment Banking. Thank you again.
Thanks, Scarlett.
Scarlett.
Thanks, everybody.
Have a good day.